Hurricane Justin devastates the small business landscape in Canada. Hurricane Justin Trudeau has, through his proposals in July, basically changed the kingpin of what we accountants used to use as tax planning strategies for small businesses in Canada. Firstly, he's changed the tax deferral that we used to do. In other words, the corporation would get taxed at 15%. They would reinvest the money into the corporation, and that money would go and help them develop their business in the future. That's being changed. Income splitting. Income splitting is no longer a viable option based on the proposals that the Liberals are bringing into power. You have to justify in a small business, you have to justify that your kids are actually working in the business, that you have to track their hours, you have to track how much you're going to pay them, and you have to make sure that the remuneration is reasonable. I can't see that happening if a family member has a bakery or a restaurant where all the family members are helping in that restaurant, how they're going to keep track of it. It's going to be an administrative overload on the family, and it's going to create a real boondoggle in all small businesses such as restaurants, such as retail, such as a bakery. These businesses, who are family-run businesses, often owned by immigrants, will have to have undue administration to make sure their kids are not taxed at a 45 to 50% rate for making $10,000 a year. The capital gains remuneration. Instead of making income by making a salary, in the past we were able to use capital gains as a methodology of keeping your money at a 23 or 26% tax rate. That's being changed. Paying out of your shares that you've accumulated, shareholder equity, you were able to pay it out and then lend the money back to the company. That may not be available in the future. Using multiple capital gains exemptions, where you could use, if a family developed a business and the family developed a business, only one member of the family may be able to get the $830,000 capital gains exemption, where in the past we were able to spread that out through family members and therefore keep the wealth within the family. And they were the ones who developed the business, and they were also the ones who would be able to keep the wealth of the business in their personal hands. The other one is business succession strategies. It's important that a family be allowed to transfer the assets of a corporation to the next generation. I mean, that has been a bedrock in not only Canadian society, but in all Western European society, where family businesses have been transferred from the father and the mother to the children, so that the children could continue the legacy of the parents. While the Canadian government is putting things in place that may not allow this to happen in the future. Minimizing double taxation upon death. Well, the government, the way they're implementing their rules, they will be creating double taxation and taxation rates that could possibly be up to 95% taxes. So in other words, you will make 5% and the government gets 95%, or 75% goes to the government, 25% goes to the people in some of these investment companies. That is what the government's proposing. They're also proposing to attack corporate life insurance and other methodologies that we have used to minimize the taxes of small businesses. Those avenues may no longer be there to the small business owner. Let's stop Hurricane Justin and Hurricane Morneau from devastating the Canadian landscape.